Welcome to Lesson 15, Current Assets. Hello everyone, I'm Matt with the Fundamental Investing Institute. Welcome to Lesson 15 of our Financial Statements course. In this lesson, we'll discuss current assets. How do we know if a company can satisfy its obligations? Well, the current assets section of the balance sheet helps us answer that question. Assets are arranged based on liquidity. Current assets are those assets whose benefits are expected to be realized within 1 year or an operating cycle, whichever is longer. The most liquid of all assets is cash and equivalents. This category includes not only cash balances held at financial institutions, but also highly liquid and safe securities, such as treasury bills. The next item within the current assets section is marketable securities. These are securities that can be easily sold for cash, but whose risk is slightly higher than securities considered cash equivalents. Companies invest in these to earn interest income while still having access to liquidity. Accounts receivable is another item on many balance sheets. These arise from sales where customers are allowed to pay at a date later than the sale date. They are essentially IOUs from customers. Because not all receivables will be collected, companies must set up a reserve for uncollected accounts. This reserve is what is called a contra account. A contra asset reduces the value of a regular account. With contra accounts, the debit and credit entries are reverse those of the account that it is adjusting. Inventory is another item reported within current assets. It represents the goods a business holds for future use or sale. Inventory is carried on the balance sheet at the lower of acquired cost or net realizable value, which is what a company expects to sell the asset for after all costs. Inventory that cannot be sold for its original cost must be written down to its net realizable value. This ensures that the balance sheet accurately reflects the resources available to the firm. Companies will also have prepaid expenses, payments made in advance for services not yet received. These are recognized as assets and expensed as they are consumed. Finally, other current assets capture smaller items that don't warrant their own line. These are the major categories of current assets. It is important to understand them because they indicate a company's liquidity and its ability to satisfy short-term obligations using available resources. In our next lesson, we'll discuss non-current assets. Please visit our website for more resources, and remember to like and subscribe to our channel. I'll see you in the next lesson.